Good morning, Jags. This is Fahad. Today is Thursday, July 23rd. Bunch of exciting things on my screen this morning. I want to start off with Microsoft this morning. The stock is going to gap down slightly after closing at 212 and change last night. It's going to open around 208 this morning. Here's something to keep in mind. I want to see how the option traders are going to position right after market open. So keep an eye on the weekly call option. So the implied volatility in the front week, July 24th and the July 31st, it's going to get crushed. It's going to collapse from what was over 100% down to about 35 to 40%. So that means those premiums are going to come down sharply as a result, and these options will become extremely cheap. If there is going to be a red to green reversal on this stock, then watch how the volume will flow in right after the market opens in the weekly July 24th and the July 31st weekly call options, particularly at the 210 and the 212.50 strike in short term. There might be a play if you're just quickly day trading, if this thing goes from red to green reversal. Quickly taking a look at the actual earnings report, which is also covered in the first read this morning. Just keep this in mind that the biggest red message was that Bing search results were down sharply because the advertising spend has been cut by so many small and medium-sized businesses, which is we're seeing across the board. We saw that in Snapchat earnings report. We saw that in Twitter as well. Although Twitter basically had strong monetization, but the ad spending overall was down. And then we saw this in Bing research also. This is also a read through for Google. However, if you look outside of that, 47%, a record 47% growth rate, new record high in terms of total absolute revenues for cloud, for Azure cloud. That's just absolute blowout. I mean, that's a monster number. So you have already a lot of analysts that are coming out this morning that are saying that that they're basically defending the stock as the stock is down this week. And so overall, let's see if this thing is going to make from a red to green reversal. And if so, keep an eye on those short-term call options when the trade starts, when the market opens. Now, the next thing is that I want to discuss NTGR real quick. We have call options, August 30 call options in this one, which we bought yesterday going into earnings, and this thing will open around $33 per share. Now, I discussed this briefly last night in Telegram, and then also this is covered in the first read this morning. It's worth reading these comments from the CFO and the CEO of the company. I mean, think about what was consensus telling us. Consensus was looking for 10-15% growth rate, but here we are in its most important segment company talking about 37% growth rate. Monster beat on top line, monster beat on bottom line. Similarly, very strong commentary going forward for the third quarter and the fourth quarter. In terms of actual revenue growth, this is very high numbers when you look at the last 8 quarters of history as to what kind of top line revenue growth company has been producing. And then it's not only just on its biggest segment, which is the Orbi, Nighthawk, Pro Gaming, and Mural brands. You go further down the list, and these comments would suggest that there is momentum in the name. Far more paid subscribers. The company talked about the number of paid subscribers is going to double. They're on the pace for doing that for the rest of the 2020. And they also talked about significant exposure to 5G hotspots, which is giving them a big boost with 110% sequential growth rate in shipments in the second quarter. Now, I bring this up because while we're going to have some very nice gains this morning on those short-term call options that we bought yesterday, but you actually, if you look at the long-term weekly scale, this is a 3-year chart in front of you. And if you look at this, this thing used to trade at 25, 30 times earnings. It used to be a $78 stock at its peak. And for 2 years, it has come down to a level, and then it posts a quarter of this magnitude. I mean, you have to ask yourself, so they're benefiting from 5G, they're benefiting from work from home, they're benefiting from sharp increase in networking equipment that businesses and individuals have to buy in order to work from home. And his stock is trading if I just normalize this, and I understand this is not the best way of looking at it because you have to take into account seasonality factors, but if I just look at the earnings per share that the company posted last night, which is about 56 cents, I believe, on the EPS line, and I simply multiply that by 4, even though Q4 is generally the strong period for the company, you're looking at an earnings power of about $2.20. And then on top of it, there is exactly what I expected. Margins have expanded. And I mentioned this in my preview that if the company takes its operating margins from 7% to 10%, as they have promised, that alone will add to about $1.25, incremental $1.25 EPS to its bottom line. So if you take the $2 earnings per share normalized and then you add the $1.25 to it, you get to more than $3 earnings per share power, possibly by 2021. And the stock is trading at 32. It's trading at 11 times earnings. Used to trade at 20 plus times earnings. And or you can apply the enterprise value over sales multiple and look at where the stock has come down. I'm wondering, basically what I'm trying to get at is I'm wondering if this is actually heading to 40, 50, $60 per share with the type of quarter that the company posted. I mean, I was pretty bullish going into earnings, but maybe I'm truly underestimating the potential here. By the way, the company also has very high short interest. Well, not very high, but I believe it's about 8 to 9% short interest. So that's also going to get squeezed. So keep an eye on this. Add this to your watch list, not just for the trade idea that we did yesterday, but perhaps there is far more to come. And this will continue to potentially push higher. Last thing, I will also mention Twitter because we have September 40 call options in this one, and this stock is sharply guided higher, trading just below $40 per share. I already discussed briefly in Telegram. The most important metric was MDAU, which is the daily active users that are monetized, and it was well above the expectation, which is exactly what I was expecting. Total revenues was a miss, no question about that, but that's also because the advertising spend in the second quarter was cut for a lot of social media properties. But that doesn't matter right now. What matters is that the user engagement continues to be so robust. Ultimately, and then in the future, whether it's in third quarter or fourth quarter, those advertising dollars come back. You can just imagine how this company could then start to print significant amount of money and top line revenue growth will take off. I will just add one more color that and the company is acknowledging in its press release this morning that they are working on a new subscription product. We do not know, and nobody has it in their model. So this would be a complete brand new addition to its top line revenue growth. But they did say that they need to do a lot of back office work to launch it properly. This will take time. A lot of engineering in the background needs to be done. So they pushed the deadline. They said if we're going to have a subscription product, it's not going to be out until early 2021. Well, keep in mind, we're only 6 months away into 2021. So we're going to get analysts to start looking into that and start building some sort of assumptions around it. Anything that analyst community builds about this into their models will be all incremental to top line revenues, a subscription business. So keep that in mind. That's a new growth driver that's coming ahead. We do not know much about it at this particular time. So great day for a lot of these ideas for us this morning. Keep an eye on Microsoft, see how it performs. Chronicle.
Morning, everybody. So one of the things I'm seeing right now is with the general sentiment around 5G and network equipment stocks being beaten down lately, and I think there's going to be a lot of upside surprises when these companies report. Because for several quarters now, the market has been disappointed that the 5G rollout wasn't quite as fast as it was hyped up to be. But I think those expectations have swung too far to the bearish side now, and it's resulting in a very low bar for these companies. It's almost like it's gone from being an overhyped and overcrowded trade to being an almost ignored one now. And the two companies I'm watching are Keysight, symbol KEYS, and VIAV Solutions, symbol VIAV. So JP Morgan was out with a note yesterday basically confirming my views that this sub-industry of 5G network equipment is going to report strong sequential improvements over the back half of this year. And they think it's going to result in a catch-up trade because they're seeing strong visibility into demand in both R&D as well as field. Additionally, in the case of VIAV Solutions, JP Morgan is seeing improved 3D sensing outlook as well. And for the company as a whole, they're currently modeling higher, 15% higher earnings and revenue projections than the street. Personally, I think it's doable. One thing I'll say about VIAV is that their CEO, Oleg Kakin, he's probably the most conservative CEO in this industry. Like if you look at the past earnings call transcripts over the past couple years, what you'll find is that he tends to be much more negative on the 5G rollout and the industry in general compared to his peers. I understand not wanting to overhype, but this guy is like extreme. Like he constantly just talks down the prospects of his company and 5G, and he's also known to be critical of other companies who talk up the prospects of 5G. And this sort of downbeat commentary has been one of the major overhangs on VIAV stock price. But if we were to look at the most recent earnings transcript, what we'll notice is that the CEO has all of a sudden taken a much more positive view. For example, when he was asked about the status of 400 gig rollouts, the CEO answered by saying the company is seeing very strong demand for all the test equipment, and he sees this demand continuing for the rest of the year. And he's expecting, quote unquote, very strong demand across all segments. And he went on to say that the advanced products and the production of 5G and 400 gig will continue to be stronger from here. This is very unusual coming from him because usually he'd be more like, yeah, look, we just posted a great quarter, but this rollout is not all it's cracked up to be, so let's not get our hopes too high. Let's just wait and see. Basically, he's been preaching conservatism. So for him to suddenly turn positive like that, I think it's saying something. And also another catalyst I'm seeing that no one has talked about is VIAV's banknote segment, which is somewhere just under 20% of revenue. Basically, they provide the anti-counterfeiting technology for governments worldwide for when they're printing banknotes. Normally, this is not a very fast-growing segment, but the CEO has said in the past that the company sees increased demand when there's fiscal stimulus because, physical notes get printed. So we've just had the EU finalizing their stimulus, and we also have the bill in the US coming up. I think I see some hidden upside here. Meanwhile, just quickly looking at Keysight, more or less the same commentary from JP Morgan. Keysight management has pointed out to order trends remaining strong in their guidance for July end quarter. And going forward, JP Morgan is increasing its estimates for the October quarter, basically for Keysight to now deliver 1.15 billion in revenue on a more constructive view of the capacity constraint and backlog digestion. And for the full year, they're increasing their revenue estimate to 4.6 billion and EPS up to 5.15, which is comfortably above consensus of 4.49 and 5.08 respectively. I have to agree. But meanwhile, when I look at overall estimates for 2020, consensus has, for some reason, gradually lowered its estimates over the last couple months for Keysight, while just last week, VIAV's estimates were also slightly lowered. So there's a growing disconnect here.
Great stuff over there. I want to quickly point out on the technical side of this thing. So Keysight actually has been our favorite as a 5G play for quite some time. We have traded this around earnings as well. So now with those thoughts that you just provided with consensus coming down, while the networking equipment has seen surge or interest in sales, this would be an interesting one to potentially play into earnings. Let's keep an eye on this downtrending resistance, see if it starts to break out from this. And VIAV solution, this was actually a former top pick in the Jaguar quarterly outlook. So definitely one to watch with all the thoughts about conservatism from the CEO that you discussed. I just want to throw in Arista Network into this one as well. This has been actually on my watch list for quite some time, and I'm trying to still collect some strong channel checks, see if I have conviction here to make a play. If you look at the daily scale, there's a lot of heavy congestion over here. This would also be naturally any kind of beneficiary if a strong is spending it, especially on the cloud computing side, and if it's related to networking side. So let's see if this thing can start to clear the $240 resistance. And if you look at the long-term weekly scale, you can see a better picture over here as to how many times it has failed here, and it's now coming up to that resistance. If there are strong channel checks on this one too, we will discuss those in the chat room and provide potential trade ideas going with it. Great stuff, Chronicle. Jay?
Morning, Todd. So I am looking at Dollar General, DG. So last month, Piper Sandler had a note out that caught my attention, and I had kind of put it off to the side. But then yesterday, Morgan Stanley had a note out that talked about most of the same things that Piper talked about, but just more with an update on what has occurred over the last few weeks. And all of those have to do with DG's initiatives. The first one is DG Fresh. Let me just send a quick picture. So this is essentially in their stores selling fresh produce, refrigerated goods. The initial objective of this initiative is to reduce product cost by removing the 25% markup paid to the third-party distributors. The company expects to enhance this assortment, including private label, in 2021 when those contracts with the distributors run out. Now, that was Piper. Morgan Stanley was out saying they expect DG Fresh to be operating margin accretive starting this year, and it has been a gross margin driver, and it is starting to make a difference. Now, switching to private label, Piper had noted that the company was seeing more customers switch from branded product to private label product amidst COVID-19. Morgan Stanley then came out and reiterated that, saying COVID has created an interesting dynamic as people have been more open to trying new brands just to get their necessary products. They've been doing a lot of rebranding, relaunching. One example was DG Baby. They rebranded it to Gentle Steps, and they've already been seeing good results from that. They've also been more intentional with their advertising, using compare and save methods, 100% money back guarantees, sort of to drive these private label purchases. And those have been resonating well with them. And the last initiatives is our NCI, which is non-consumable. Just send another quick picture. Currently, NCI is in approximately 3,000 stores, and the goal is to have them in about 5,000 by the end of the year. The categories that are in this initiatives would be home, kitchen, seasonal items. DG is keeping inventory low, so you can get the products turned over rather quickly. And according to Morgan Stanley,
it's also good for margins. The last thing I ever want to see from any retailer is keeping large inventory while sales are under pressure or muted for any reason. It's very good for margins, low inventory levels all the time.
Yeah, and so Morgan Stanley was just saying, this initiative is possibly impacting the mix. The home category was a major growth driver in Q1, and is just a good example of the success that this initiative is having.
Yeah, this is a beautiful technical setup, and in multiple times, actually, there has been high volume accumulation during this 2 month of consolidation, and it is just starting to break out through that. So it becomes a very easy one to play, which is if you're playing the breakout, you put your hard stop at, in this case, I would say 185, which is the lower end of that recent range. And then you basically continue to trade the momentum, and all those thoughts about overall spending, inventory controls, and product developments, as well as the grocery part, very, very constructive. The only thing I will add to this, that keep in mind that, you know, at least in the last quarter or 2 quarters ago, these guys were sort of hurt because of the COVID-related shutdowns, you know, led to people flocking to the internet side. And so anybody that had an internet portal basically benefited the most in the retail space than the actual physical locations. I mean, I don't know if we still have this problem. People are wearing masks, they're going out. And so I think that some of this, especially on the essential businesses, traffic has started to improve, but I don't think that bear case is stand anymore, particularly related to companies like Dollar General, Dollar Tree, where that actually benefit from people trading down at a time of a high unemployment rate. And so this should be beneficiary. Good stuff. Before I go to Avo, I want to quickly mention that one of my clients, Sam Mendel, he's in the chat room all the time, just sent me these 2 snapshots he took from his TV, I'm assuming, about DraftKings. And he mentioned that DraftKings, DraftKings, I guess this must have been from the management that was just on Bloomberg channel talking about this. And they said that since the PGA has come back, every single week seems to be the best ever we have ever done, said Johnny Avello, DraftKings director of bookmaking. And also said that as big time sports fell one by one in March, DraftKings and Flutter Entertainment, FanDuel hatched crazy ways to entice America's gamblers. Now they're gearing up for the real thing, starting with Major League Baseball opening day Thursday, today, and investors look like real winners. So some very constructive, positive thoughts from the management on Bloomberg this morning. I did notice that the stock was actually starting to tick higher in pre-market. Let's see if this can actually catch some more strong momentum. It's one of my highest conviction plays, so I've loved this name, and I think the future is very bright. Great stuff. Avo.
All right, looking at Crown Castle this morning with earnings about a week away. I would like to see some notes, maybe pre-earnings as well, but so far I don't have anything more recent than just what I have. So what do we have back in the last earnings report? The company said that they were really not that much affected by any COVID-related issues of slowdowns or anything like that. Demand has not been affected. Small cell delivery cycles also not touched. And it appears that business is going on as usual. More recently, saw a JP Morgan commentary that that also points to the same direction, that the activity, tower activity, has been high and should remain high for this year at least going forward. And lastly, there was recently a letter by Elliott Management, or not a letter, but apparently Elliott Management has been talking with Crown Castle. Now Elliott owns $1 billion worth of stock in Crown Castle. They would like them to take a look at their board of directors. Is it? I think so. Sorry.
I'll just add to your color.
Sure.
This company is beneficiary of similar kind of a strong trends that we have seen in 5G space. And this actually has been on my watch list as well for an entry. But I was sort of actually disappointed from the recent lackluster trend, particularly even when we had good news out on the 5G. So I have not made a play, and I've been waiting for rather a more constructive technical price action. It needs to hold this wedge or channel that it has been forming. If it does pull back, I think a better entry will come around $160 per share with a hard stop, $1 to $2 below that. So that would be my way of technically actually placing a bet going into earnings. Until then, I'm pretty much on the sidelines. But as far as the overall fundamental color is concerned, this company remains a powerful name with a small cell deployment in all kinds of urban locations to prepare to create a dense network for 5G. It's at the forefront of that, and I don't think that theme has stopped at all. I think it's going to continue to be very strong for many more quarters to come. So
yeah,
keep an eye on
and
this.
their top customers are their top clients are the top providers of service, cell phones.
The key here, in order to see how Crown Castle is doing, is to observe the capex trends related to 5G from AT&T, Verizon, and T-Mobile, and all of these big telecom providers. If we start to see, if we continue to see higher and higher capex trends, because these, for example, AT&T and Verizon, they spend somewhere between $20 to $25 billion a year in capex. And if you start to see they're continuing to push more and more in that direction, with numbers holding steady or strong or even accelerating, that is tremendously positive for Crown Castle, for the leasing activity that the company provides for its towers, as well as for the small cell deployment. Good stuff, guys. Thank you very much for joining, and lots of coverage over here. We'll see you in the chat room shortly.